There is a number your bank will show you, and there is a number your life can actually survive. And in 2026, the gap between those two numbers has never been wider. Get this maths wrong, and you don't just end up with a slightly tighter budget. You end up with something far quieter and far more dangerous. A decade of mortgage imprisonment, a lovely front door, a beautiful kitchen, and absolutely no freedom left to breathe, to change jobs, or to actually live. So before you let a lender tell you what you can afford, let's do the honest maths they'd quietly rather you skipped. Let's start with how the bank thinks. Most UK lenders still work off a simple multiple of your income, and the number they love is 4.5. So if you earn £40,000 a year, the bank looks at you and sees a loan of £180,000, clean, simple, and, frankly, a relic. Because that 4.5 multiplier was built for a different Britain, a world of cheap energy, gentle council tax bills, and stable everything. It measures your salary, but it is completely blind to your life. It doesn't know your energy bill has doubled. It doesn't know what your council tax band actually costs. It's legacy maths, being stretched over a brand new, far more expensive country. So let's translate a loan into a life. Take a £300,000 mortgage at 5%, which is roughly where a 5-year fixed rate sits in 2026. Spread over 25 years, that's around £1,750 every single month, just for the loan itself. But here's what the bank's shiny calculator conveniently forgets to mention. First, council tax, the hidden mortgage. On an average Band D home, that's creeping close to £2,400 a year, roughly £200 a month, and you will pay it every year, forever, until you move or die. It never gets paid off. It's a mortgage that never ends. Then, energy and insurance. Keeping a drafty Victorian semi-warm through a British winter in 2026 will comfortably run you well over £150 a month before you've paid a single penny to insure the bricks around you. And then the silent one, opportunity cost. Every single pound you send to mortgage interest is a pound that is not compounding inside your SIP or your ISA. Over the full life of that £300,000 loan, you will hand the lender well over £226,000 in interest alone. Read that again. That is not a house. That is a second, invisible house, one you're buying for the bank and never get to live in. So stack it all up, your £1,750 mortgage, £200 of council tax, then energy, then insurance, then the boiler service, then the leaking gutter nobody warned you about. Suddenly your £1,750 home is quietly costing you well over £2,200 a month to simply exist inside. And not one penny of that extra cost ever appeared on the affordability form you signed. Now let's get honest and break this down by what you actually earn. First, the median earner. On around £35,000 a year, at 4.5 times income, the bank offers you £157,500. Now, up in parts of the north, the Midlands, or the northeast, that is a real home, a terrace, a garden, a front door of your own. But carry that exact same number down to the southeast or into the home counties, and it's almost tragic. It might buy you a share of a leasehold flat, backing onto a dual carriageway. Same salary, same loan, two completely different lives, decided entirely by your postcode. Next, the professional couple, on £80,000 combined. Here the bank rolls out the big, seductive number, £360,000. On paper, you've arrived. In reality, welcome to the squeezed middle. That loan alone costs you around £2,100 a month before a single bill lands. High income, high mortgage, high nursery fees, and, this is the trap, almost zero margin. You look wealthy on the mortgage application, and you feel completely broke by the 20th of the month. One boiler failure, one redundancy, one dead car, and the whole thing starts to wobble. Then, the high earner, on £120,000. And here the maths turns genuinely brutal because it has a name, the 60% tax trap. The moment your income climbs past £100,000, HMRC quietly begins stripping away your tax-free personal allowance, £1 gone for every £2 you earn above it. The effect is an eye-watering effective tax rate of 60% on that band of income. So while the bank cheerfully dangles a £540,000 loan in front of you, The actual cash arriving in your bank account is not growing anywhere near as fast as that loan is. You are, on paper, rich, but the taxman has quietly taken the exact money you needed to make the repayments. On £540,000 borrowed, the payments push past £3,000 a month, while your take-home, throttled by that 60% band, simply refuses to keep pace. The lender is lending against a salary the government won't actually let you keep. Which brings us to the deposit, your loan-to-value, or LTV. A 10% deposit is the absolute bare minimum to get through the door, but understand what it costs you. A high LTV means the lender sees you as higher risk, so you get parked in the most expensive interest tier there is, and you'll pay for it every month. The real magic happens at 25% down. At 75% LTV, you drop into a far cheaper rate band, your monthly payment falls, and, quietly, this is where genuine wealth building actually begins. And don't forget the tax on top. Stamp duty can swallow a serious chunk of your savings before you've even bought a doormat. The gap between a 10% and a 25% deposit isn't about pride. Over the life of the loan, it can mean tens of thousands of pounds saved in pure interest. Now, the ghost that haunts every single fixed-rate deal, the renewal. Everything I've described so far assumes 5% holds, but your fix ends, and when it does, you step back into the market at whatever rate is waiting for you then. So let's stress test it, the way any honest advisor should. Take that same £300,000 mortgage and add just 1.5%, up to 6.5%. Your monthly payment doesn't nudge. It jumps by nearly £300 to just over £2,000 a month. So ask yourself, honestly, right now, if that letter landed on your doormat at your next renewal, does your lifestyle bend or does it break? Because if the honest answer is break, then you haven't bought a home, you've bought a bet. So here is the golden rule of British housing, the one number that cuts through every clever calculator and every optimistic estate agent. Add up your mortgage, your building's insurance, and your council tax. If that total swallows more than 30% of your take-home pay, the whole relationship has flipped. You do not own the house owns you. Look at our median earner. Net pay of around £2,400 a month, but a mortgage alone of nearly £920, and that's before insurance and council tax shove it clean over the line. Now look at the professional couple. They might bring home £5,200 between them, but a £2,100 mortgage, stacked with the British essentials, eats straight through that 30% barrier. The number the bank approved, and the number your life can genuinely carry, are simply not the same number. They were never the same number. So here's the truth that both of us, the economist and the mortgage advisor, want you to walk away with tonight. A house is a home first, and an investment second. Everyone in 2026 is chasing the biggest loan they can possibly qualify for, when the real prize, all along, was the smallest loan you can comfortably live inside. Because true wealth in this country was never the size of your hallway or the postcode printed on your letters. True wealth is a front door you can lock at night, without a mortgage that has quietly locked you into a job you can no longer afford to leave. So borrow what your life can carry, not what the bank says you can bear. Because that one decision, more than any interest rate, any multiplier, or any headline number, decides whether the next 10 years feel like a home or a sentence. If you learned something from this video, don't forget to hit like and subscribe to this channel. See you in the next one.